ETFs that I use. And there's all kinds of ETFs that do this. But the point is, when you do this, two things happen. Let's take an example from last year. My top two holdings were Apple and Boeing. Now, they have been for the last 3 years. Every quarter, because they grew so fast while they're paying dividends, I had to sell them down to 5% and redeploy the money in other stocks. That means I was selling my winners. That's what happened. Apple has recently lost 30-something% of its value in 2 months. I don't care. I made all that money while it was going up. I'm not getting hit with that. I've already got all my money out of Apple because it was so successful for 4 years while I owned them. The downside of this strategy is you'll only get 80% of the markets. You'll never get 100% of the upside because you're selling your winners. But when the market corrects like it is now, you've already covered yourself. You're only participating in about 63% of the downside. It's a very important rule. It takes discipline, but you can buy ETFs to do it. It's the free lunch. The only free lunch investing is diversification. Number two, we just added 2 years ago real estate to the S&P. The reason everybody lost their money in the dot-com bubble boom was they let internet stocks become 80% of their portfolio. They got slaughtered when they corrected. You can never let a sector like technology become more than 20%, or energy, or defense, or anything. Up to 20% is the max, and that's it. So you have to trim it, and again, ETFs do this for you. There's sectoral ETFs. Number three, this is my mother's rule, do not own a position that doesn't return capital. Anything that doesn't return capital is a speculation. People say, well, what about all the FANG stocks? And I said, well, guess what? If you had just bought the companies in the S&P in the summer of 2015 when all these tech stocks like Netflix and everything else started running, you would have underperformed for 36 months, but now that they've blown up, you're ahead of them by 3% if you just owned the stocks that were quality dividend payers. How crazy is that? Again, proving that over a long period of time, dividends are really important. I have always a minimum of 35% of my portfolio in bonds. Bonds don't pay a lot right now, about 3.6%, 36-month duration, triple B. Now, I do not use ETFs for bonds. I hire managers and I pay them. I pay an advisor, a woman that does this for me. I call her Mrs. No, she hates everything, but she's very conservative, and she manages the bond portfolio. And that's a stable part. It doesn't go up and down like the market does. It just produces cash every month. When you pass the age of 40, you should start thinking about preservation of wealth over performance. Don't take risks. It's hard to make money back when you lose it. You want to be more conservative. And finally in life, you will find that poo-poo happens. You don't know when, you don't know why, but it's going to happen to you. A car accident, a catastrophic illness in the family, someone's business fails, something like that's going to happen and you need cash. I like to keep 10%. You can make about 2.1% now in all these banks that are online with cash. And it's a good thing because you're beating inflation, but at least you have it at a time of an emergency. I want to end with a story that I think you're all going to have to